The Precious Metals Week in Review, August 14th, 2015. Brought to you by Precious Metals International. Volatility continued this week as China's central bank roiled markets with its monetary moves. U.S. stock markets saw wild swings this week as they tried to absorb the devaluations of the Chinese yuan that took place this week. The number of Americans filing new applications for state unemployment benefits edged higher again for the third week in a row, climbing by 5,000 claims to a seasonally adjusted level of 274,000. The previous week's data was revised to show 1,000 fewer applications than previously reported. Despite the third weekly rise, economists continue to view the U.S. labor market as strengthening and thus adding further support for an interest rate hike by the U.S. Federal Reserve in September. In China, the People's Bank of China surprised markets around the world on Tuesday by deliberately devaluing the yuan by nearly 2%. The yuan fell against the U.S. dollar for the next 3 days, and Reuters, citing powerful voices within government, reported that there were calls pushing for the yuan to go still lower, suggesting pressure for an overall devaluation of almost 10%. The reports prompted the PBOC to announce on Thursday that such reports were groundless and that the central bank would keep the yuan stable. Many viewed the surprise devaluation as the direct result of an 8.3% drop in Chinese exports in July, the largest such fall in 4 months, as Beijing may be seeking to boost export numbers higher by essentially decreasing the cost of those products and goods. In the U.S., the Dow Jones Industrial Average, DJIA, dropped 277 points on Tuesday following the PBOC's surprise devaluation of the yuan. Wednesday saw the DJIA shrug off fears that the deliberate devaluation signaled that Chinese leaders were concerned over the country's prospects for economic growth, and the DJIA erased the losses of the previous day. Former Dallas Fed President Richard Fisher told CNBC on Friday that China's monetary moves should not be used as an excuse by the U.S. Federal Reserve to delay raising interest rates. Mr. Fisher said, "I think this would put the Fed in an awkward spot to use this as an excuse. Hyper-doves may use this as an excuse, but I don't think it obtains." In Tianjin, one of China's largest and busiest ports, a massive explosion blew apart a dangerous goods warehouse late Wednesday night. The city's government said that 50 people were confirmed dead and as many as 700 were injured, some seriously. The extent of the damage to the surrounding area is still being surveyed. The explosion is also likely to affect the operations of some U.S.-based companies that use the busy port to import goods and supplies from China. Companies with facilities nearby to the blast must have the damage assessed, and workers that have been evacuated from the area over fears of hazardous fumes will be unable to return to home or work until the safety of the environment and air quality can also be assessed. In Greece, the government debated yet again over the reforms that its creditors will require in order for Athens to secure yet another round of bailout funding for the debt-laden country through the night on Thursday. Early Friday morning, a vote was finally held, and the bill was officially approved by a margin of 222 votes for to 64 against. The decision now moves back into the hands of Eurozone finance ministers who are meeting in Brussels Friday to determine whether the bailout should move forward. After the bailout was approved in the Greek parliament, Reuters cited a Greek government official as saying that Prime Minister Alexis Tsipras would seek a confidence vote following the August 20 deadline for a payment that is due to the European Central Bank. If that confidence vote takes place and fails, then any additional bailout progress could be set back once again, as Greece would have to hold yet another general election. Elsewhere in Europe, the European External Action Service, EEAS, said in a statement released on Tuesday that recent attacks on Ukrainian areas controlled by Kyiv violated the current ceasefire agreement and risked sending the war-torn country back into full-blown civil war. The group said, "The renewed escalation of the conflict violates the spirit and the letter of the Minsk agreements. The Minsk agreements must be implemented in good faith, starting with full observation of the ceasefire and genuine withdrawal of heavy weapons." Brent crude oil pushed back near $50 a barrel this week, despite a fourth straight rise in the weekly Baker Hughes oil rig count and continued fears of oversupply due to dwindling demand as China's economic data continued to prove weak. The euro began the week moving higher against the US dollar in fits and starts, finding a top late on Wednesday and then declining slightly and essentially trading sideways for the rest of the week. The euro appears set to close the week higher against the US dollar. The Japanese yen began the week moving steadily downward against the US dollar before finding a floor early on Wednesday and surging higher. The yen could not maintain its upward momentum for the rest of the week, but did not return to its lows and appears set to close the week out essentially sideways against the US dollar. Volatility should be expected to continue. Global uncertainty continued this week as China shocked markets by deliberately devaluing its currency on Tuesday in what may be another salvo in the ongoing global currency wars, as central banks all seem to be racing to see who can devalue their fiat currency the fastest. Most analysts believe Tuesday's move was designed to shore up China's flagging exports number, as a cheaper yuan might boost demand for Chinese exports in much the same fashion that a cheaper Japanese yen spurred recent demand for Japanese exports. Even as the currency fell, presumably with the goal of boosting exports, one of the busiest ports that moves goods into and out of China suffered a major catastrophe on Wednesday after two explosions tore through the area surrounding a hazardous goods warehouse. The final explosion was the equivalent of 21 tons of TNT, according to seismologist data from the incident. An investigation is ongoing to determine the exact cause of the explosions and the nature of any hazardous substances that may have been released into the surrounding area. The impact is still being assessed as to how much damage was caused to the port area, its facilities, and outbound inventory that was on site and near the affected area while awaiting departure. In Europe, tempers appear to be flaring again in Ukraine as pro-Russian separatists apparently began targeting sites controlled by Kyiv in an escalation of violence this week that goes directly against the current ceasefire agreement between the two sides. In typical fashion, Ukraine and Moscow stand on opposite sides of the issue. A statement issued by the Russian Ministry of Foreign Affairs accused Kyiv of refusing to promise artillery withdrawals that were supposed to diffuse regional tensions, saying, regrettably, Kyiv has sharply stepped up its militant rhetoric. A counter-statement issued by Ukraine's Ministry of Foreign Affairs said, "Shelling, aggressiveness of Russian terrorist forces, intimidation of the OSCE Special Monitoring Mission observers, all this is a part of deliberately chosen dangerous line aiming to stall Minsk agreements. The Russian side has to take immediate steps to stop any actions that bring destruction and death to Ukraine and threaten the security and stability on the whole European continent." In Greece, the parliament voted to approve the latest reforms that will be required to unlock further bailout funding after a marathon all-night session which was full of the usual rhetoric and strife. The deal, which calls for additional austerity measures in addition to spending cuts and other reforms, has left the governing left-wing Syriza party experiencing a growing rebellion within its ranks. Reuters reported after the bailout deal was approved 222 votes to 64 that Prime Minister Alexis Tsipras intended to hold a confidence vote in the coming weeks, which, if it fails, would lead to another general election which would likely completely derail the desperately needed bailout process once more. Greece is effectively bankrupt and probably would not even be able to make the payment it owes to the European Central Bank on August 20th, without the aid of the pre-bailout bridge loans it received shortly following its capitulation to creditor demands for more reforms. Any delay in the bailout funding currently being discussed will likely trigger another round of chaos in the beleaguered country for its citizens and businesses. Today, CNBC reported that the flight of investor money from U.S. stocks has turned into a stampede. In fact, the $78.7 billion leaving domestic equity-focused funds has been worse in 2015 than it was even during the financial crisis years, when the S&P 500 tumbled some 60%, according to data released Friday by Morningstar. The total is the highest since 1993. Quoting Morningstar senior analyst Alina Lamy, CNBC said, "Apart from flows following performance, this pattern also hints at investors' expectations for the future. The consensus is that the United States is in the late stages of its bull market. Globally, countries are cheaper on a fundamental level, and Europe and Japan are still actively stimulating their economies. Investors are aware that the United States and Europe are at different points in the economic cycle, and this is reflected in the flows. Reading between the lines, as they say, it appears that this Morningstar analyst believes that investors are speculating that a looming interest rate hike by the U.S. Federal Reserve in the face of continued monetary easing by Europe, Japan, and other global central banks is likely to put an end to the bull run in the U.S. stock market, and these investors appear to suddenly be seeking other places to invest their funds." In South Africa, the two largest unions at gold mining companies say that wage negotiations have broken down, bringing the possibility of a strike in the mining industry, which is already operating at reduced capacity, closer to reality. Mines have cut back production by shutting down many of their mines in the face of lower precious metals prices, which have made their continued operation unprofitable. A further restriction of the supply of precious metals under strike conditions could result in upward pressure on prices for physical precious metals, especially if the capital that appears to be leaving the U.S. stock market suddenly finds a home in a renewed demand for physical precious metals amid escalating global uncertainty and threats of war, both physical and monetary. As we enter the weekend in the face of ongoing negotiations in Brussels over the details of yet another Greek bailout, and the specter of the People's Bank of China potentially downgrading their currency further, it remains important to monitor global news outlets for events that could trigger a sudden surge in demand for physical precious metals. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products, and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, August 14th, 2015. Brought to you by Precious Metals International.